Cash flow to the firm. Cash flow to the firm valuation, also known as free cash flow to firm, FCFF, is a method to estimate a company's intrinsic value by calculating the present value of all its future cash flows generated from operations after accounting for necessary investments and expenses, essentially representing the total cash available to both debt and equity holders before any debt payments are made. This is then discounted using the company's weighted average cost of capital to arrive at a present value which reflects the company's theoretical worth. Key points about cash flow to the firm valuation: what it measures. This method focuses on the company's ability to generate cash from its core operations, considering factors like depreciation, taxes, working capital changes, and capital expenditures. How to calculate. Step 1. Calculate operating cash flow. This is the cash generated from the company's primary business activities, including sales revenue minus operating expenses. Step 2. Adjust for non-cash items. Add back depreciation and amortization to the operating cash flow. Step 3. Account for capital expenditure. Subtract the amount spent on new investments in property, plant, and equipment. Step 4. Factor in changes in working capital. Adjust for any changes in accounts receivable, inventory, and accounts payable. Step 5. Discount future cash flows. Using the company's weighted average cost of capital to discount each projected future cash flow to its present value. Example: imagine a company called Tech Inc. that has an operating cash flow of $100 million, depreciation of $20 million, capital expenditures of $30 million, and a weighted average cost of capital of 10%. Calculate FCFF, operating cash flow $100 million, add back depreciation of $20 million, subtract capital expenditures of $30 million. That brings our FCFF to $90 million. Valuation. Assuming analysts project the company to generate a stable $90 million FCFF each year for the foreseeable future, they would discount this cash flow using the 10% weighted average cost of capital to arrive at a present value, which would represent the estimated intrinsic value of Tech Inc. Important considerations: accuracy of projections. The accuracy of a cash flow to the firm valuation largely depends on the quality of future cash flow estimates, which can be challenging to predict. Sensitivity analysis. It's important to perform sensitivity analysis to understand how changes in key assumptions, like weighted average cost of capital or growth rate, impact the valuation.